Shall we start now? Right, we have to continue from the discussion. So just to recap the things we discussed last week, you remember we got this discussion on this portfolio. If you recap the things, first we discussed how to determine return and the risk for the individual assets based on the past historical data as well as based on the forecasted data. Then we construct the portfolio. We discuss only the two asset portfolio. So in case of the two asset portfolio, we can calculate portfolio expected return is no problem. That is weighted average of the individual stocks expected return. But when it's come to the portfolio risk, we are using this double summation approach. I told you the reason because this formula you can expand when number of assets in the portfolio is increasing. You can expand this formula to what number? But if you apply this statistical method, even statistical method is possible, but it's very difficult to apply to calculate the portfolio standard deviation or portfolio risk. So therefore, we are using this double summation formula, not this statistical method. Right, I think you remember we discussed with one example. So those are the answers. We discussed this thing also. We calculate correlation, covariance, and everything. So these are the numbers. So these are the answers we got from our example. Now here you can see this is two assets X and Y. If you invest X only, you can get 4.68% as the expected return. If you invest Y only, it is 3.42. And these are the standalone risks. If you consider the individually, this is the standard deviation. This is the standard deviation Y. So we discussed this thing. So if you construct equally weighted portfolio, equally weighted, 50-50. So then your portfolio expected return is 4.05. So you can see here your portfolio risk, portfolio standard deviation has decreased to 2.28. If you invest X only, this is the standard deviation 4.67. If you invest Y only, this is the 4.51. If you construct a portfolio using X and Y, so you can reduce risk with the fair return, because portfolio return also around 4.05. So you can reduce the risk up to 2.28. So therefore, I told you that by looking at these numbers, you should be able to decide whether there is a diversification advantage, risk diversification advantage by constructing this portfolio. To answer to this question, you have to look at this correlation coefficient, and also covariance say something. But correlation coefficient is better because it exactly says how the diversification impact on the this portfolio standard deviation, and how the diversification or risk diversification impact on the risk of this portfolio. Now, if you look at here, this correlation coefficient for these two stocks X and Y, they are for movement, and the size of the movement even you can interpret by looking at this correlation coefficient. It is minus 0.51. It means that they are moving to the opposite direction. Right? So when X stock return increasing in a particular time of the economy, Y is decreasing. If X is increased by 1%, so then Y is decreasing by approximately 0. I explained this thing actually. So by looking at this correlation coefficient, you can say the direction of the movement as well as the size of the movement. in a particular time, because of some event, because of some happenings in the economy, if its stock return say is increasing, say by 1%, it can be 10%, 100%, whatever. If its stock return if increased by 1%, what happens to the Y? Y is decreasing by 0.51. They are negatively related, but not perfectly negative. So this is minus 0.51. So there is a diversification advantage. There was a rule of thumb to decide that one. When the weighted average standard deviation value, right? So weighted average standard deviation value of this portfolio, you can calculate standard deviation stock X 4.67 into 50% plus standard deviation Y 4.51 into 50%. So you will get some answer here, right? So this is a rule of thumb. If your portfolio standard deviation, if it is less than the weighted average standard deviation value, so we normally we are telling that there is a certain degrees of diversification advantage. That is the rule of thumb. So you can calculate weighted average standard deviation value and you can check this with the portfolio standard deviation. Now here portfolio standard deviation is 2.28. So you will get here, you can calculate what is the answer here. Weighted average standard deviation of this portfolio, it is 4 point something, 4.59. 4.59. So you can see weighted average standard deviation of the portfolio stocks is greater than this, or our portfolio standard deviation is less than the weighted average standard deviation value. So therefore there is a diversification effect. There is a diversification advantage. As far as this correlation coefficient is more close to the negative one, the diversification benefit is high. The diversification advantage is high. Now in this case, it is very close to the negative one because it is minus 0.51. So therefore, your risk diversification benefit is high. Your portfolio standard deviation is 2.28. That is the point I think I stopped last week. Okay? Right. Some more few things I have to mention, and these are for further discussion. I think we discussed this one also. If the correlation coefficient of the two stocks is exactly 1, right? If correlation coefficient is equal to 1, portfolio standard deviation is equal to the weighted average standard deviation value. Right? Remember, when the correlation coefficient, if it is equal to 1, perfectly positive. Perfectly positive. So then your portfolio standard deviation, this is 2.28, exactly is equal to the weighted average standard deviation value. At that time, there is no any diversification advantage, no diversification benefit, right? Because simply portfolio standard deviation also is on a straight line. It is weighted average standard deviation. So therefore, no diversification benefit. With the diagram, I will show you that. Okay. When the correlation of two stocks is less than 1, if it is less than 1, then the standard deviation of the portfolio, this number is less than the weighted average standard deviation of the stock. As far as the correlation coefficient less than 1, there was one correlation coefficient lying between -1, 0 to +1. This is the path. If the correlation coefficient is perfectly positive, no diversification benefit. There is no diversification advantage. If correlation coefficient is say 0.5 positive, since the correlation coefficient is less than 1, moderate level, some sort of diversification is possible. I make a perfectly positive name, this is 0.5. It means that when, say, stock X return is increasing by 1%, Y stock return is increasing by 0.5. Not perfect. Trade-off this return trade-off. So therefore, certain degrees of diversification is possible. That is the meaning. However, if it is perfectly positive, there is no diversification advantage. Since the correlation of two stocks are in general less than 1, so normally in a portfolio, market portfolio, if you identify a portfolio, if you calculate the correlation coefficient, in general, it is normally less than 1. Right? It is normally less than 1. So therefore, the standard deviation of the portfolio is less than the weighted average of standard deviation of the stock. So this effect we call diversification advantage. So that advantage depends on the correlation coefficient. The correlation coefficient, let us say minus 0.95. So the diversification advantage is very large. With the 0.5, if correlation coefficient is negative 0.95, so you will get benefit. This diversification benefit than the when the correlation coefficient is 0.5. Both cases there is a degrees of advantage. Advantage එකක් තියෙනවා. Risk diversification එකක් තියෙනවා. හැබැයි මේක negative එකට if it is perfectly negative, the benefit or the advantage or the effect of diversification is high. So that means that you can minimize risk and you can maximize return. You can have a maximum return at a minimum level of risk. That is the meaning. Now, if you recall our starting point of the portfolio, I told you that investors are having two expectations. One is maximizing return. Other one is minimizing risk. So these two objectives are conflicting. So to achieve the goal to a moderate level, so we are constructing portfolio. Right? So your risk diversification or the advantage of the risk diversification depends on this correlation structure for various structures. From this point onwards, portfolio management is started. Right? Right? From this point onwards, you will learn portfolio management. I think if you are specialized in this subject, I think one who does portfolio management. So then you will learn efficient frontier, market portfolio. So these things you can learn. So from this point onwards, these topics, these things are coming. Right? Are you okay with this thing? I think Mama so now we have to discuss this thing. Okay? Huh? Why? What is the reason for the law? Portfolio management? Right. Now look at this one. This is a separate example. This is a separate example. So you can see two stocks are there. Stock M and stock N. So you are given expected return and standard deviation for these individual stocks. So by changing the correlation coefficient and also using the different weights, right? So you can construct many number of portfolios. There are so many combinations. Combinations by changing the correlation coefficient as well as the weight of the investor. you can invest 50-50, 60-40, 10-90, 70-30. So likewise, you can change the weight as well as the correlation coefficient. You can put -1, +1, 0. So likewise, changing. Different portfolios are constructed using the above two stocks by changing their respective weights and also the different correlation coefficient values. Right? You are not well? You need some Panadol? Okay. But everything in order, everything. Right. Now, I think these are two stocks, expected returns and standard deviations are there. Now look at this. If you construct different portfolios, changing the weights, by taking the correlation coefficient as a -1, you know, -1 means perfectly negative. Then අපේ double summation formula එකේ අපි correlation coefficient එක -1 කියලා දෙන්නේ. So you are changing the weights 50-50, 60-40. So likewise you can change the weights. See, අපි equally weighted නෙමෙයි හැමලේම ඒක වෙනස් කරලා. So if you construct the portfolio in the Excel, you can do this without problem. You can do this. So the path of your portfolio expected return and standard deviation is look like this. Right? So now if you look at this point here, this is the stock N. If you invest stock N only, this is your standard deviation. In the x-axis, Nepathian standard deviation. In the y, you can see expected return. Standard deviation, expected return. So if you invested your total wealth on N, stock N, so this is your risk, standard deviation, this is your expected return. Then make a point. So you can see the hard type. Which part? That is the point. Right? If you invested M only, your total wealth you are investing on M. So then your risk is there here, and your expected return is here, 15% something. So once you construct the portfolio using this M and N, taking the correlation coefficient is perfectly negative. Correlation coefficient is perfectly negative. So if you construct the portfolio using different weights, so by changing the weights, so this is the path or the behavior of your portfolio or expected return and the standard deviation. Portfolio standard deviation. Now if you look at this diagram, you can see what happens in this point. මේ point එකේ මොකද වෙලා තියෙන්නේ? Portfolio standard deviation 0. Portfolio risk is 0. Portfolio expected return something like 22.320, so something like that. But the portfolio standard deviation 0. So that is the point. If you can identify stocks with the perfectly negative correlation stocks, there is a chance to minimize risk total. You can diversify risk total. That is the meaning. But practically, identification of the stocks with the perfectly negative correlation is very difficult. It's an extreme number. They are extreme numbers. But anyway, theoretically, there is a possibility, chance to minimize the risk, diversify the risk total. That is the meaning. So the method una බලන්න මේ දෙන්නගේ risk එක මෙතන තියෙන M වල මෙතන තියෙන M වල මේ දෙන්න එකතු කරලා portfolio එකක් ගත්තොත් මේ risk එක අඩු වෙගෙන යනවා portfolio එක වල අඩු වෙගෙන කියලා මෙතන එනකොට යාට පුළුවන් risk එක බිඳුව කරන්න. So through this portfolio you can totally diversify diversified away the risk. මේක වෙන්නේ correlation coefficient එක perfectly negative වෙන අවස්ථාව. දැන් බලන්න මේක. If correlation coefficient is 0, then our double summation formula එකේ correlation coefficient එක 0 දාලා ඔයාලට මේව calculate කරන්න. So when the correlation coefficient is 0, this is the path. This is the path. Moderate level diversification is possible. බලන්න මේ individual stocks risk එක, මේ M1 risk එක, මේ N1 risk එක. Moderate level diversification මෙන්න මේ දක්වා risk එක අඩු කරගන්න පුළුවන්. මෙතනට අඩු කරගන්න පුළුවන්. හැබැයි when the correlation coefficient is 0, මේ line එක never approach to here. මෙතනට එන්නේ නැහැ කවදා. But moderate level diversification is possible even when the correlation coefficient is 0. There is a chance to diversify the risk to a moderate level. And the correlation coefficient if is equal to 1, look at the path. So then you can see this is the risk of the stock gain. This is the risk or standard deviation stock gain. So your portfolio risk, portfolio standard deviation in between these two. එක මෙතනින් එහාට අඩු වෙන්නේ නැහැ. මේක අඩු වෙන මේ N1 risk එක අඩු වෙනවා. හැබැයි මේ අඩු වෙන්නේ මේ level එකට විතරයි. මොකද මේ මෙතනදී portfolio risk එක is on the straight line. Portfolio risk is moving on a straight line because weighted average standard deviation. When the correlation coefficient is equal to 1, portfolio risk is equal to the weighted average standard deviation value. So therefore, you can see portfolio risk, portfolio standard deviation line in between this, the risk of the stock N and the risk of the stock M. So no diversification advantage. There is no diversification benefit. By constructing a portfolio when the correlation coefficient is perfectly positive, no diversification. Right? So this is you can actually construct even using the Excel, but I am not going to that next step. So my point is, this is the feasible set of portfolios when you have two stocks in your portfolio. Your portfolio के stocks दिखाई नहीं देंगे, मैं तमाम वाले feasible set of portfolios. मैं मेरे यहाँ पे क्या करते हैं छोटा what you call theoretical. I will explain. और हमारा विभाग के बारे में क्लास में करेंगे, but anyway I think you will feel interested. Right? So therefore I will continue with that because you should know what happens from this point onwards. Now suppose you are an investor, you are going to construct the portfolio using the stocks in the Colombo stock market. So how to identify your portfolio, your efficient portfolio, how to construct? So that theoretical insights I will provide very briefly from this point onwards. Right. Now, my problem is, I think you remember when I start this lecture, I wrote a formula like this. You remember? Required rate of return is equal risk-free rate of return plus risk premium. I started with this formula. So the risk-free rate of return for the time value, risk premium for the bearing of the risk. Right? Now, by constructing the well-diversified portfolio, as a logical, rational investor, you have a chance to minimize risk up to 0. If you are a rational investor, without any cost, you can minimize risk up to zero. So then what is the point of providing risk premium if you can minimize risk up to zero? ඔයා හොඳ portfolio එකක් construct කිරීම තුලින් හොඳ well diversified portfolio එකක් maintain කිරීම තුලින් ඔයාලට පුළුවන් risk එක zero කරගන්න. Theoretically there is a chance. ඒතකොට එහෙමනම් ඇයි අපි මේ risk premium එකක් දෙන්නේ? No need to give this risk premium. Because this is a free lunch. This is a free cost. මේකට cost එකක් කියන්නේ නැහැ. මේක ඇති වෙන්නේ මේ trade off එකේ risk return trade off එකේ benefit එකක්. මේ ඉන්නේ risk return trade off එකේ benefit එකක්. There is no any cost. So then why is risk premium? Risk premium for bearing systematic risk. Risk premium is provided for what? For bearing systematic risk. When it's come to the total risk, using the standard deviation, you measure the total risk, right? So that you can only the unsystematic part of this total risk you can minimize up to zero. But there is this risk we call part of risk systematic risk. Right? So I will explain. So the total risk consists with the systematic and unsystematic risk. The systematic risk we can say non-diversifiable risk. Even though you have a well-diversified portfolio, that is you cannot diversify it. That is systematic. Example systematic risk it can. So if I say the example like this, this systematic risk is equally affected all of us. අපි හිතමු අපි ඔක්කොම investors ලා. එතකොට මේ systematic risk එක අපි හැමෝටම එකම විදිහට බලපාන. So the things like say interest rate changes, policy rate changes, foreign exchange exposure, government or political some situations, natural disasters like coming say tsunami or earthquake kind of things. So these are some systematic risk factors. Even though you have a well-diversified portfolio, that systematic risk you cannot diversify. It is impacted on your investment. But unsystematic risk or we call diversifiable risk. අපි කියනවා විවිධාංගීකරණය කිරීම කියන්නේ හොඳ portfolio එකක් පවත්වාගෙන යාම තුළින් විවිධාංගීකරණය කරලා අයින් කරගන්න පුළුවන් කොටස. That is unsystematic risk. So what is the unsystematic risk? It is firm-specific risk factors. Abhi the company, there is a particular company you have invested. They are using low quality inputs. Their production process is out of date. In the company there is a very unrest, labors, and also trade union actions. They are doing some damage to the environment. They are not doing social responsible investment. So these are firm-specific things, firm-specific factors. So these things you can diversify. You can invest in another company. You can withdraw your investment and you can go to another company. Or you can invest with the company which is negatively correlated with this company, with this industry. Right? So likewise, unsystematic risk, you can diversify. දැන් අපි හිතමු ඔයාගේ පෝර්ට්ෆෝලියෝ එකේ ඔයා ඉන්වෙස්ට් කරලා තියෙනවා කුඩ හදන කම්පැනි එකයි අයිස්ක්‍රීම් හදන කම්පැනි එකයි. වහින කාලෙට කුඩ ඕන අයිස්ක්‍රීම් කන්නේ නැහැ. ඒතර ඩිමාන්ඩ් එක අඩු වෙලා ඉවත් වහිනවා. හැබැයි පායන කාලෙට අයිස්ක්‍රීම් වලට ඩිමාන්ඩ් එක වැඩි වෙනවා. නෙගටිව්ලි රිලේටඩ් නේ. අන්න ඒ වගේ දෙයක්. ඒතර this part you can diversify the way. These are firm specific. A company के employees लगे unrest එකක් තියෙනවනම් so you can withdraw your investment and you can invest in another company or you can invest with the rival company. Competitor. So likewise, this unsystematic risk or we call firm specific risk, that is you can diversify the way by constructing the portfolio. But systematic risk, nobody can diversify. So therefore, I think it is there. The systematic risk component depends on the macro factors of an economy. interest rate වෙනස් වෙනවා. ඔයාට බලපානවා මටත් බලපානවා. government එකේ unstability එක අපි ඔක්කොටම බලපානවා. tsunami එකක් ඇවිල්ලා පැත්තම යනවා. It's affected to all. So these are systematic risk factors. Political මොනවා හරි අපි හිතමු geopolitical matters දැන් අර රුසියාව ගහනවා ඉස්රායලට ගහනවා. So the impact is coming to all of us. So these are systematic risk factors. And also it is unavoidable. As an investor, you cannot avoid it. Government එක interest rate එක policy inflation setups එක ඔයාගේ portfolio එක පැත්තකට කරන් තියන්න ඉන්න පුළුවන්. It's unavoidable. It's affecting. Your return is impacted on it. It cannot be diversified away by constructing the portfolio. So you cannot diversify. So risk premium is provided for what? In this formula, this is investors' required rate of return is equal premium for the time value, premium for the risk. So risk premium provided for what? For bearing which risk? What about it? Systematic risk. So then what is the relevant risk? මොකක්ද අපි කතා කරන risk එක? Systematic or unsystematic? Systematic risk. මෙතනින් එහාට අපි කතා කරන campaign, Markowitz model, everything has developed based on this systematic risk. මොකද unsystematic risk is not a matter. ඒකට මොනවද දෙන්න ඕනේ? ඔයා අරමම ඉන්වෙස්ටර් කෙනෙක් නම් ඔයාට පුළුවන් වෙනවා unsystematic risk එක අයින් කරගන්න. No need to provide any premium. That is, you can diversify. But this systematic risk cannot diversify the risk. So as an investor, you are expecting some premium for bearing this systematic risk. Right? So then this premium is provided for bearing systematic risk. So unsystematic is component specific to the particular company, particular industry, particular stock. It can be diversified by constructing a portfolio without incurring, without any cost. Without any cost. After you make a free launch, no any cost. So you can diversify that part. So therefore, no need to provide any premium. Now, if you look at this diagram, you can see what you can see. This is portfolio risk. Here in the x-axis, number of stocks in the portfolio. This is total risk. So total risk consists with unsystematic, systematic. When the number of assets in the portfolio is increasing, so number of assets our portfolio is diversified. When the number of assets are increasing in your portfolio, your total risk, your total risk is decreasing in line with the number of assets. It is decreasing and decreasing, but it stopped at this point. So your total risk will be decreased. It's decreasing when the number of assets here is increasing. By the portfolio is stocks, but it's a well diversified. There a correlation, covariance structure again. Robot column matrix covariance structure. When number of assets are increasing in your portfolio, your total risk is decreasing up to this point. Weathering decrease in that. Weathering it's not there is no decrease because this one systematic risk. Irrespective of the number of assets in the portfolio, systematic risk remains constant. It remains constant. Number of assets value not get a major balance. Right? Number of assets value not get a major impact. Total risk unsystematic part diversify this systematic risk remains constant. In our make premium given. Okay. Right. If you have premium calculate cap Markowitz model ගොඩක් දාලා නැහැ මේ මාකට්ස් මොඩල් එකයි මේකේ efficient quantity එක ඔය lending borrowing portfolios ඊට පස්සේ capital CML line එක විතරයි that's all beta factor එක අනිත් beta එක ඔයාලගේ syllabus එකේ තියෙනවා Right. Right. So now you can see two diagrams there. In your market, if you have two assets only, what is the market portfolio mean? It is the in very simple format. It is the combination. Of all risky assets. That is we call market portfolio. Now, in our Sri Lankan context, what is our market portfolio? That is our Colombo Stock Exchange portfolio. So that consists with the 298 stocks and the 20 sectors. So that is our risky portfolio. It is the market portfolio, right? In the market, if you have only two stocks, so this is your feasible set of portfolio. Where market portfolio is stocks දෙකයි නම් what portfolios හදන්න පුළුවන් possibility එක feasible set එක මේ මෙන්න මේ විදිහට තමයි තියෙන්නේ. දැන් අපි දෙකක්නේ කතා කරගෙන ඉන්නානේ. හැබැයි in the practice your market portfolio consists with the 3,000, 5,000, 6,000 stocks. If you look at the USA, India, and the UK night market, listed companies around 3,000, 6,000. We have only 298. Right? So with our 298 companies, listed companies, this is Markowitz portfolio theory. This is a sort of theory coming from the portfolios. If you construct different portfolios using these 298 stocks, then this is our portfolio. So ඒවා මේ softwares තියෙනවා. ඒකට මේක ඔයාලා portfolio කරද්දී මේ market execution quantity ඔයාලා අඳිනවා Excel එකේ. So you can do that. There are different portfolios if you construct your what you call a feasible set of portfolio. Feasible. එතන ඔයාලට හදාගන්න පුළුවන් portfolios ඔක්කොම ඇතුළත් වෙන set එක. Feasible set of portfolio it looks like this. ඒක theoretical finding එක. දැන් අපි ඕනම මාකට් එකකට feasible set එක identify කරගත්තොත් මෙන්න මේ වගේ කුඩියක් වගේ shape එකක් එනවා. This is the feasible set of portfolio. එතකොට මේ හැමතැනම තියෙන portfolios. මෙතන portfolio එකක් තියෙනවා, මෙතන portfolio එකක් තියෙනවා, මෙතන තියෙනවා, මේ line එක උඩ තියෙනවා, මේ line එක උඩ තියෙනවා. හැබැයි මෙහි තියෙනවද? නැහැ. So this is the feasible set of portfolio. You can construct by using some inputs, listed companies. In this feasible set of portfolio, then maintain the stocks දෙකක් ගන්නවා නම් feasible set එක. මේක project කරන්න. දැන් අපි මේ දෙකකට හැදුවේ. එතකොට in this feasible set of portfolio, this black shaded one from here to here. From here to here, we defined as a efficient set of portfolio. In the feasible set එකේ දැන් මේ ඔක්කොම feasible. මේ portfolios වල හදන්න පුළුවන්. In this feasible set of portfolios, the portfolios lie on this line. ඒ කියන්නේ මෙතන ඉඳන් මෙන්න මේ හරියට නිකන් තියෙන portfolios අපි identify කරගන්නවා efficient portfolios. These are the efficient portfolios. Why? This is explaining the feasible set. Now look at same picture. So this is feasible set. So now in this feasible set, P, B, C, D, R, are efficient. They are efficient. IFP efficient portfolio කියන්නේ now in this diagram, in the y-axis, this is return. This is portfolio return. This is portfolio standard deviation. Portfolio risk. දැන් අපි ගත්තොත් එහෙම මේ feasible set එකේ ඔයා මේ portfolio එක තෝරගත්තොත් I think you can understand Sinhala නේ nobody is there නේද Sinhala තේරෙන්නේ කොහොමද ඉන්නවද? Family නේද දැන් කොහොමද? You can't. Huh? Alright, okay. Now if you select this portfolio, this is a portfolio Q. Is it efficient portfolio? Why? Huh? Tell me. Now if you say, now this is the feasible set of portfolio. We portfolio. We have the Laksagana portfolio. So now if you select this one, Q, is it efficient portfolio? No. Why? Why is that Q is not efficient portfolio? So that Q is not the efficient portfolio because now this risk level, this is the risk of this portfolio. If you select this Q, this is the risk of this portfolio. For this risk level, you can go up to C. Right? So as a rational investor, you always trying to get the maximum return at a minimum level of risk. If the risk is identical, if the risk is identical, now if you go to this C and Q, the risk is identical. They risk is same. But if you are selecting this Q, you are not rational. You are not rational. For this risk level, if you select this Q, it is not efficient because for this level of risk, you can go portfolio C. This portfolio C is an efficient portfolio because it is now for this degree of risk, this is the maximum return that you can earn. That is efficient. Make it efficient. Risk that is the maximum. Make efficient for this level of risk. This is the maximum. So that is why the portfolio on this efficient frontier we identify as the efficient portfolio. I think it is explained. All other portfolios which lie outside the efficient frontier are inefficient portfolios. So inefficient portfolios have a lower return and higher risk. Lower return and higher risk. Now if you select the Q, return is low, risk is high. The more risky you can have the higher return. So therefore you can go to the C. So the concept, efficient frontier, efficient portfolios, are you clear? Right? So as an investor, you should try to invest on this efficient frontier in order to get the higher return. The method these portfolios are correctly priced. These portfolios are correctly priced. Correctly priced means for the given level of risk, it is correctly priced so that return is fair. Right. Right. So now this efficient frontier without any risk-free investment. This efficient frontier includes only the risky investment. But as an investor, sometimes you may invest in the treasury bills, treasury bonds in your portfolio. So you might have certain risk-free investment. So if you introduce risk-free investment to this efficient frontier, so your efficient frontier is going to align like this. The efficient frontier, this is the efficient frontier. Medical the efficient frontier by introducing the risk-free investment to this Markowitz efficient frontier. So then your efficient set of portfolios is going from RX M to Z. Right? This is mathematically constructed things. Make a very mathematical. If you go to the Google and you may search Markowitz 1957 portfolio theory, so these things are there. Mathematically prove again. So then by introducing the risk-free investment, your efficient quantity is was. This is risk-free investment. Market portfolio is right. So then this line, this efficient frontier, also we mentioned as the capital market line. Efficient frontier we define as the capital market line because it provides the efficient set of risk-free and the risky securities. It shows the risk-return trade-off of the market equilibrium. You can better read this. Now this efficient frontier with the introducing of the risk-free investment, we define as the CML line, capital market line. Because capital market line provides all efficient set of risk-free and the risky securities combination. Now you can invest here, you can invest in the market, you can invest here. If you are investing from RF to M, in a way, from RF to M, if you have a portfolio somewhere here, so that is we call lending portfolio. Lending portfolio. I think it is there in the next slide. So portfolios from RF to M, we call lending portfolio because now suppose you have 100,000 to invest. So invest 50,000 in the market risky portfolio, market ticket, as the investor. Another 50,000 you are investing in the risky investment. So that is we call lending portfolio. So all the investors are in RF to M. May invest करना है वो पे identify करना these portfolios we identify RF to M method as the lending portfolio. So M2 upwards, the portfolios. M2 upwards we call borrowing portfolios. Because in the borrowing portfolios, suppose you have 100,000. So what you are going to do? You invest your 100,000 in the market portfolio, and in addition, you are borrowing some money, at least at risk-free rate, or you are investing in the market portfolio. That is the meaning. Right? Borrowing portfolio means then wagawa access here. If access invest करला, अभी तो काम 5,000 पढ़ाने का है. अभी धीरे-धीरे करके अभी नाइट गाली at least at the risk-free rate. इधर borrow कर हुआ नहीं, वो यार साली वो यार invest करना risky market portfolio. So that is we call borrowing portfolio. So therefore, in this capital market line, portfolios from RF to M we identify as lending portfolio. M to upwards we identify as borrowing portfolio. Now, if I ask simple question, now there is a lending portfolio and the borrowing portfolio. Who are the risk takers? Investors in lending portfolios or investors in borrowing portfolios? Who are the risk takers? Investors in the borrowing or lending portfolio? Borrowing. Because I have 100,000. Total 100,000 are invested in the market portfolio. Market portfolio means risky market portfolio. In addition to that, I am borrowing another 100,000, at least at the risky rate. It's also I am investing there. So I am a risk taker. That for investors in the lending portfolios, they are risk-averse investors. So that two behaviors you can identify with this lending and borrowing portfolio. Forget about these things. Now the important thing, this is our formula. I started with this. I told you that I am ending with this. are correctly priced. It means that uh, according to its risk level, the premium is capitalized. That is the meaning. Again, risk premium make a method capitalized. These are correctly priced. How to calculate expected return for this efficient portfolio? Now you know that in the capital market line, all portfolios lying on the capital market line are efficient. All the portfolios are efficient. මේ line එක උඩ තියෙන portfolios ඔක්කොම efficient. They are efficient portfolios. So if you want to calculate the expected return for the efficient portfolio, this is the formula. You can calculate slope of the CML line. You know, formula for the slope is equal delta y divided by delta x. This is the formula. So based on that, you can estimate the slope. The slope we can find under systematic risk. For unit of systematic risk, the given premium. Slope is provided the premium given for per unit of systematic risk. So slope you can calculate expected return market. This is market portfolio. Expected return market minus risk-free rate divided by this is standard deviation of the market portfolio. Whether MT market portfolio, risky market portfolio. So slope you can calculate expected return market portfolio. Expected return market portfolio you can calculate based on the all share price index. Market return you have to calculate based on the all share price index. The difference between the all share price index you can calculate market return. So expected return market minus risk-free rate, that is based on the treasury bill or treasury bond yields, divided by market portfolio standard deviation. So you know how to calculate standard deviation for normal portfolio. Same formula you can apply to calculate the standard deviation of the market. So that will provide the slope. So expected return on an efficient portfolio then is equal to risk-free rate of return plus risk premium. For this risk premium, now for what? For bearing systematic risk. In an efficient portfolio, all the unsystematic risks are diversified away. In the efficient portfolios, there is no unsystematic risk. In the efficient portfolio, no unsystematic risk. So only the systematic risk is there. So we have to pay premium for the systematic risk. So therefore, expected return you can calculate risk-free rate plus slope of the capital market line multiplied by standard deviation of your portfolio. Then where may likely put a portfolio, it can be a lending portfolio or borrowing portfolio. The slope is provided systematic return provided for unit of systematic risk. This slope you can multiply by your portfolio standard deviation. Your portfolio standard deviation totally indicates only the systematic risk. Why? Now your portfolio is on capital market line. But the portfolio is capital market line. So this portfolio is efficient. No unsystematic risk. So that portfolio standard deviation indicates only the which is systematic risk. So this is, I don't know whether you can capture. Now look at these numbers. Risk-free rate is 10%. Market expected return 15%. Standard deviation market portfolio 15%. If you need, you can note down this thing. RF is the risk-free rate of return. This is risk-free rate of return 10%. Expected return market, ERS, expected return market portfolio. Expected return market portfolio, sigma M, standard deviation of the market portfolio. Standard deviation of the market portfolio. Now you can estimate the slope. Slope means return provided per unit of systematic risk in the market. Market एक systematic risk एक given return slope is equal based on the capital market line. Market return expected 15 minus risk-free rate 10% divided by standard deviation market. So you will get the slope as the 0.3. This is the slope. So this is the price of systematic risk. Systematic risk unit given a mean. That is the mean. Price of the systematic risk. Right? Price of the systematic risk. So then suppose you have an efficient portfolio. Then what is an efficient portfolio? Efficient portfolio you have a portfolio on CML line, on the capital market line. Your portfolio standard deviation is 12%. Your portfolio standard deviation, efficient portfolio standard deviation is 12%. This 12% indicate only the systematic risk. Why? The main standard deviation make only the systematic risk. Why? This is efficient. This is an efficient portfolio. Make it unsystematic risk diversified domain. Make it unsystematic risk. So therefore, standard deviation indicates only the systematic risk. Then our expected premium here. The price of the systematic risk is the slope multiplied by your portfolio, efficient portfolio standard deviation. So then your expected return 13.96. 13.96. So this is based on the CML or the security market line equation. Expected return you can calculate like this. Any question? Do you have any question? Yes, sir. Can you understand this? Yeah. CML line. Market CML line efficient quantity. CML line portfolio portfolio is efficient. CML line based on the CML slop, you can estimate the expected return. Make expected return correctly systematic risk in the price here. The problem with this one that we have portfolio, but it is not on the CML. Portfolio is zero, but it is not on the CML. CML that portfolio is not efficient. That portfolio is not efficient. Then how about expected return? So CML based expected return calculation is okay if you have efficient portfolio. But if you have inefficient portfolio, the inefficient portfolio calculation CML not on the CML. So then your portfolio expected return you can calculate using capital asset pricing function. That is the capital. That is the where the capital base function, or we call based on the security market plan. So there we are connecting with the beta coefficient. Right? It has given you the right. So now the problem with the CML, right? If your portfolio is on this line, if your portfolio on the CML, based on the slope of the CML, you can estimate the expected return. But if your portfolio is there, below or where in other place, in the, out of the CML, so then your portfolio is not efficient. So then how to estimate your required rate of return? So that we can connect with. So you can read CML give the expected return standard deviation only for efficient portfolios. That is the problem. It is only for the efficient portfolios. The problem is that only gives expected return standard deviation for efficient portfolio. So then expected return standard deviation for the inefficient portfolio. Even for the individual stocks. Now, I can stock it with the investor. The systematic risk is clear. So you have a problem. Only you have invested only one company. So then how to estimate the systematic risk? You have a portfolio, but it is not efficient. So then how to estimate your required rate of return? You can estimate based on the forecasting probabilities. Estimate, but this is based on the market. This is based on the market using this CAPM model. So then we are going to this capital asset pricing model. Capital asset pricing model. So then CAPM is coming. This is theoretically, empirically strong finding. If you search this one, you can identify 1960s, 59, 55, 63, three main people, scholars are there in Europe with this CAPM model. At that time, they are getting the Nobel Prize for that in 1959. Maybe model get a Nobel Prize second. So even today, to estimate the cost of capital, they are using this capital. We estimate the cost of capital using the capital asset pricing model. You can apply this. So what is this capital? It says that. So you can see CAPM is a model that provides required rate of return and risk. Now the systematic risk here they define as the beta risk. Beta. Then with the CAPM you may come up with a new variable that is beta coefficient. Right? So that is this CAPM is coming with the beta coefficient. So that systematic risk they capture using beta coefficient. So then model that provides required rate of return and risk or the beta risk relationship of all assets when they are held in well diversified portfolio. Well diversified portfolio either efficient or not. If the portfolio is diversified, after portfolio assets diversified portfolio, but it is not efficient. Efficient it is not on the CML line, but it is a diversified portfolio. If you have a 20 stocks in your portfolio, it's a diversified portfolio, but it is not efficient. It is not efficient. If you have a portfolio or individual assets, if they are not efficient do not make model like a power. Even for the efficient portfolio, you can apply a CAPM to estimate the required rate of return. This is very prominent development in our finance history, but today we are using CAPM. This is one factor model. with this capital now it has developed with the 4 factors, 5 factors. Now the factor here beta coefficient. But now there are so many empirical development to this model in the empirical treatment. Right. So under the CAPM, so they are coming a line SMN. We call security market line exemplifies the relationship between assets, risk and return. So according to their model, again that same model, required rate of return for individual stocks or portfolio of stocks is equal risk-free rate of return plus beta coefficient of that particular portfolio or that individual stocks into market return minus risk-free rate. So this is the model. At least you may take this model into your mind and you will be able to apply the model to estimate the required rate of return. So according to the segment line, CAPM, so required rate of return is equal risk-free rate of return plus for individual stocks. Stock size. This can apply not only the individual stocks, even for the portfolio. Either efficient or not. Even for the efficient portfolio, this model you can apply. Equal beta coefficient for the stock I into return market portfolio minus risk-free rate of return. So this is the CAPM model. In this model, so the new factor is coming beta. So this is the SML line. This is the SML line. The slope of this SML line actually we are calculating as the beta. Either using the regression or using the formula you can estimate beta. So according to this CAPM, SML or the security market line with the required rate of return or the risk beta risk relationship from all A, that is okay. If your individual assets or your portfolio, if it is lie on this SML line, right, according to the CAPM, it is correctly priced according to its systematic risk. That is the meaning. There are investment portfolio the individual stock may SML line if it is lie on this SML line, so that is correctly priced. Again, a portfolio risk individual stock risk premium price. If your stocks in somewhere here, it is undervalued. That particular stocks is undervalued. If it is your portfolio is somewhere here, that is overvaluation. So in financial management, we are using to identify overvalue, undervalue stocks using this CAPM. I'm not going to discuss this thing, but anyway, using SML line. If the stocks are lying on this SML, so that is correctly priced according to its systematic risk. Right. So then beta. The beta coefficient you can calculate. This is beta coefficient is equal covariance. Covariance අපි කලින් කතා කරලා තියෙන්නේ. Covariance between stock I and market portfolio. Right? Covariance between the return of this stock I and the market portfolio divided by variance of the market portfolio. Say this is the market portfolio. We have 298 stocks. Suppose this is say Galle. This is one of the company. You have invested in this company. So this is our market. This is our market portfolio. So you want to identify systematic risk of this company in order to estimate your required rate of return. So then you can calculate covariance between the returns of the stock. The main stock return is price difference stock return covariance between the return of the HAL and the market return. Market return again all share price index base market return. Divide by variance of the market. So you can calculate standard deviation variance for the market. So that is provided. The AKM දෙනවා මේ particular company එක මේ total market එකත් එක්ක තියෙන covariance එක. ඒක තමයි systematic risk එක කියලා කියන්නේ සම. According to the captain. මේ company එක මේ අනිත් market portfolio එකත් එක්ක කොහොමද covariance වෙන්නේ. So that shows the systematic risk. When market එක කියන්නේ market portfolio is the portfolio where well diversified risky portfolio. Always remember beta coefficient for the market portfolio is equal to 1. That is theoretical. Always beta coefficient for the market. Beta coefficient for the market portfolio is equal to 1. එතකොට මේකට සමාන්තරව තමයි අපි common beta define කරන්නේ. Always beta coefficient for the market portfolio 1. මේකේ දැන් මේ කම්පැනි එකේ බීට එක ගන්න පුළුවන් ඊට පස්සේ දාලා මේකේ බීට එක හදන්න පුළුවන් සම්පත් එකේ බීට එක හදන්න පුළුවන් so you can calculate beta for all 298 companies එතකොට market portfolio beta කියන්නේ weighted average so that is equal to 1 just take this into mind so then since the stocks beta measure its contribution, you can read this one. Since the stocks beta measure its contribution to the risk of the portfolio, beta is the correct measure of the stocks risk. There are many particular company may market portfolio के risk के contribution. We measure using the beta. In addition to measuring the stocks contribution of the risk to a portfolio, beta also measures the stocks volatility relative to the market. That is important. So by looking at the beta coefficient, so now you can see beta can be any number. A beta, even if you go to the stock market website, you can download beta coefficient for the whole listed companies. It is publicly available information. So beta can be equal to 1, less than 1, greater than 1. Even beta can be negative. So how to define if beta coefficient is 0.5? So what is the meaning? If it is 0.5, what is the meaning? This is Sampath Bank PLC. Beta coefficient is 0.5. So what is the meaning? How to define it systematically? Always this beta we define in compared to the market portfolio beta. Now compared to the market, the beta coefficient for the Sampath Bank PLC 0.5. It means that very simply 0.5 positive. It means when the market return is increasing by say 1%, the Sampath Bank PLC return is increasing by 0.5. That is the meaning. If market return if increased by 1%, market portfolio return again market එක තියෙන 298 companies ඔක්කොමත් එක්ක market එක return එක 100ක වැඩි වෙනවා. If market return increased by 1%, this company return is increasing by 0.5. If market return dropped by 1%, this company return is okay. Sampath Bank PLC's return. If market return decreased by 1%, increasing by how much? 0.5. Positive. So if the market dropped by 1%, this company is decreasing by less than that. So then, compared to the market portfolio, what you can say about the systematic risk of this summer countries? The market take a drop and economy come down market take a and market take a down and economy come correction. When the economy, when the market is decreasing by say 10%, this company return is decreasing by 5%. So what you can say about the systematic risk? Compared to the market portfolio, is it high or low? Low. It is low. ඒක හොඳයි. ඒ කියන්නේ ඒකේ සිස්ටමැටික් රිස්ක් එක අඩුයි. මාකට් එක වැඩි ලෙවල් එකකට මෙයා වැඩෙන්නේ හිමීට. So its systematic risk is low. දැන් අපි හිතන්න beta is 1.5. Beta coefficient is 1.5. How do you do? If market increase by 1%, this company return is increasing by 1.5. ඒක හොඳයි. වැඩි ලෙවල් එක හොඳයි. මොකද අනිත් පැත්ත රිස්ක් එක. If market decrease by 1%, may I get a so how about the systematic risk? It is high. Either when the beta coefficient is greater than 1, systematic risk is high. When the beta coefficient is less than 1, systematic risk is low. If beta coefficient is equal to 1, beta is equal to 1. It means that this particular company systematic risk is equal to the average market portfolio risk. It means that when the market portfolio increasing by 1%, this is also increasing by 1%. When the market decreasing by 1%, this is also decreasing by 1%. That is the meaning. Can be negative. There are some stocks are going to be the negative. So negative means going the opposite way. When the market is increasing, this company is decreasing. So this can be happen to the companies like mining companies. Market eකට substitute තියෙනවා. Mining එතකොට what you call the gold වගේ invest කරන companies. The market එක උඩ යනකොට අරවා පල්ලෙහාට. Market එක down වෙනකොට යනවා. So that is negative relationship also possible. So this is mainly from the mining market companies so that there can be a negative beta in the market. Now, can anyone define zero? Beta can be zero. What is the meaning? No relation. There is unrelated with the market. That is, we cannot predict. When the market is moving up, this company we have no any sort of relationship. That is also a very unpredictable situation. So that if the beta is zero, it shows that some sort of uncertainty. Right? If it is 2, it is going up and down by twice. If the beta is 2. So likewise, you should be able to interpret beta. So if you know the beta, then you can apply capital asset pricing model to estimate the, this is I think the final slide, to estimate the required rate of return. Now look at this one. Suppose the expected return on treasury securities is 8%. The expected return on the market portfolio is 13%. Right? Expected return market. One thing I forgot to mention here, the difference between the market return and risk-free rate, we define as market risk premium. Difference between the market return and the risk-free rate is the market risk premium. Market risk premium. So what is the meaning of that? This is the premium given per unit of systematic risk in the market. That is the meaning. Market systematic risk given a premium. Theoretically, this is the premium given per unit of systematic risk in the market. So difference between market return and risk-free rate is the market risk premium. So that market risk premium multiplied by your beta coefficient is your risk. It is your risk premium. Right. So market you are given treasury bill security is 8%, expected return on the market is 13%, beta is 1.3. What you can say about that? How to interpret? Now the Sage PLC beta is 1.3. What you can say about the systematic risk? Sage PLC systematic risk? High or low? High. Because it is greater than 1. Systematic risk is high. Yes. Find the required rate of return for the Sage PLC. So the required rate of return is equal. So you have to apply capital. Risk-free rate is 8% plus beta 1.3 into market risk premium. You can calculate market return 13% minus 8%. So this is the market risk premium. So then you will get the answer as 14.5. So this is the expected or the required rate of return for the Sage PLC for this level of systematic risk. The main systematic risk is 1.3. So this is the investor's required rate of return. Right? Now look at this one. Market portfolio return is 13%. The Sage PLC company investors required rate of return is 14.5. Market portfolio return also 13%. Why? Market portfolio return is right. Sage PLC investors required rate of return is 14.5. Greater than even the market. Why? මේක උත්තරයක් දුන්න කෙනා අනිවාර්යෙන්ම ඒකක් ගන්න පාඩම්. What is the reason? Market return 13%. Market portfolio return. But this company required rate of return 14.5. Greater than the market portfolio return. Huh? Very good. Very good. And that is the improvement. Yes, beta coefficient, look at the beta. 1.3. Market portfolio beta on average always equal to 1. Market whatever company is systematic is high. That is the meaning. There are 1.3 now, may company investor and the investors at a market that is the implication. So therefore, these investors required rate of return is greater than the market. So that is there because Sage has more systematic risk because its beta coefficient is 1.3. This return is higher than that expected of the typical stock or the on average market portfolio rate of return. That is because of this high systematic risk 1.3. That is the reason. That is it. But anyway, if you need, you can have your break. Shall we do some question from the tutorial? After that, you can go to break. So then I can start the question. Do you need to break? Is that? Break a past karan hadana. What? Galle teka hadana break ke kamu. Yes, me. Whatever. Break it all. So that's it, right? May. So you can see, I started with this formula. So I have ended with the same formula. So look, just go to the starting point and just recap the things we discussed. So how to calculate the required rate of return. මේ එන්න එක නෙමෙයි මේ තමයි පෝර්ට්ෆෝලියෝ එක ආරම්භය මම මේ just ඔහොම point නිකන් point එකෙන් දැම්මා විතරයි. So that is the story. If you have any questions still you can ask, right? Go to the tutorial. There are some questions I think. Right, අපි කරමු question number 8. This one, ඉක්මනින් හදන්න ඕනේ වැඩි මේ පැසිටිවක් ගන්න බෑ. This one and the question number 10. This is related to the beta. Right. And the question number 30. අපි ඉතින් ගණන් තුනක් හදනවා. 8, 10 and question number 30. Right. 8. Start with this one. You quickly, don't write the question, I will upload the list at the break. So calculate the expected return for sun and moon. You can calculate quickly. Just with the 60 sun and rest with the moon. It is 60-40 portfolio. So expected return is sun. That is the answer. Well, and remember expected return calculation. Point to probability 0.15 plus 16 to 0.3 plus 18 into 0.5. So this is the expected return sun. Same way, calculate the expected return moon. So what is the answer? Six point eight. Square point three. In moon, 13.7. Now we have to calculate variance and standard deviation. I hope you remember the formulas. Don't worry about the formulas, you might have by heart them. Variance. Deviation of this forecasted return from the expected, scale of that into probability. Here, 12.3. This is 12.3. So then variance you can calculate variance of x is equal forecasted deviation from the expected, of the deviation relevant probability 15 plus 6 minus 12.3 square root and the probability plus 18 minus 12.3 square of that probability. So this is the variance. So then get the square root of it, standard deviation. 0.00401. Calculate the standard deviation also. Six point three three the standard deviation. Standard deviation 6 point variance thickness 0.0401 polygon. 0.00401. Then standard deviation. Standard deviation is 6.331. 7.93. So these are the my answers. Okay. Then covariance correlation coefficients. So covariance you can calculate first. So, do you have the question? Then, so forecasted return, deviation from expected return rule into deviation sun and deviation moon on the forecasted into the probability plus forecasted sun deviation from expected into forecasted moon deviation from expected into probability plus deviation from the forecasted into moon forecasted 20% deviation from expected 0.04629 covariance. Correlation coefficient variance divided by standard deviation 0.9. Correlation क्या है? Covariance divided by standard deviation sun, standard deviation moon. मेरे साथ तीनों ने किया लाइक के correlation 0.9 में Now, the question. For various correlations are it. Now you can see positive correlation, it's very close to 1. Very close to 1. Since the correlation is less than 1, sort of diversification is there, but it is very weak. Very not much strength. So strength diversification but it's not with diversification because correlation is 0.92, very close to the perfect positive one. Right. So then calculate. You are going to construct the portfolio investing 60% sun and the remains on moon 60-40. Then calculate expected return of the portfolio constructed and the variance standard deviation of the portfolio. 60-40, right? 60-40. Right. So then 60-40. 60% on sun, 40% on moon. Wait. Then portfolio expected return. Portfolio expected return is equal 12.3 into 60% plus it is 12.86 portfolio expected return. Then portfolio variance and standard deviation. So you have to use this formula. Now we are using double summation formula, this one. This so correlation coefficient with the correlation coefficient is formula to calculate the portfolio variance and portfolio standard deviation. So this is the formula. So you can apply, everything is with you now. You can apply this formula. So variance of the portfolio is equal portfolio risk එනවානේ 0.69 නේ higher percentages වැඩි වගේ 6.9 දෙන්නේ කියන portfolio එක risk එක එන්නේ වලට පැටර්න් කියන ළමයි එතකොට portfolio risk and portfolio variation portfolio standard deviation කියන ලොකු ගානක් කියවලු 69ක් කියවලු එනවා weighted average standard deviation එකට වඩා ගොඩක් වැඩි the weighted average standard deviation of the individual stocks ගත්තොත් එන්නේ 6.97 මෙගාට 6.97 තමයි weighted average standard deviation value. ඒ කියන්නේ මේ standard deviations දෙකෙන් 60% 6% and 40% from the 8. that is 6.97. then අපේ portfolio එකේ risk එක ඇවිල්ලා තියෙනවා percentage ගත්තොත් 70%. ලොකු percentage එකක්. කොහොමද ඒක මේ weighted average standard deviation එකට වඩා percentage එකද? Six point 6.3. Formula क्या මේ percentages වල දෙක මේ පැටලින් ඉන්නේ යන්න එතනදී මට මේක කොතනද කියලා හොයාගන්න බැහැ දැන් අපි percentages උත් ගන්නවනේ දැන් percentage එකක් multiply වෙනවනේ අන්න ඒ ප්‍රශ්නෙත් එක්ක මේක එන්නේ ඒතර මෙතන 6.3 වෙනවා නම් එතකොට ඒක මොකද මෙයා 12% variance එක කියන්නේ ඔන්න ඔතන තමයි වරදින්නේ 40 නේ ඒක මම මාකට් කාගෙන මේක මේ ඩබල් වෙලා තියෙනවා 40.1 දෙන්න variance නේ ඒ කියන්නේ දැන් මේක 1000කින් අඩු වෙලා තියෙනවා එලා තියෙන මෙතන percentages අරන් දෙන්නවා එතකොට කියන්නේ standard deviation portfolio standard deviation වෙනස් වෙනවා හත්තා වෙනස් වෙනවා then final answer වෙනස් වෙන්නේ නැහැ for the exam we have to be careful one of the better thing තමයි මේ මමත් එක Excel එකේ මේක percentage කරලා input එක දාලා තියෙනවා ඒක percentage multiplication එකක් කරලා තමයි issue එක ආවේ දැන් මෙතන මම මේක cell එක මාරු කරලා number but 468 ඒක විදිහට දැම්මේ ඒතර මේක percentage තමයි නමුත් මම මෙතන percentage දුන්නේ නැහැ එතකොට දැන් මේක එනවා හරිය එතකොට weighted average එක එන්නේ කීයද 6.60 plus making 40. Make it a cell 6.97. Right? The make Excel make you might not get this issue. That was the mistake. Right? Okay. So these are the answers. So then portfolio variance is 71. Portfolio standard deviation 8.4. Then what you can say about the diversification effect? Since the correlation coefficient here, since the correlation coefficient here 0.92 less than 1 still, so therefore certain degrees of diversification is portfolio standard deviation is 8.4. Weighted average standard deviation value is 6.97. What you can say about the diversification effect? Now, portfolio standard deviation, you can go to this slide. Based on this point, you can conclude. You have to, since the since the correlation of two stocks are generally less than standard deviation of portfolio less than the weighted average standard deviation of the stock. Portfolio standard deviation is less than the weighted average standard deviation of the stock. Now, method 8.1. Make 6.97. Correlation account वाला calculate करना तो 6.97. So for the exam, if you have an answer here, portfolio standard deviation greater than the weighted average standard deviation 8.4 and the 6.97. Then normally our conclusion is when the correlation coefficient is less than 1. Now in this case correlation coefficient is 0.92. So that is less than 1. So then you will have some sort of diversification because it's not perfectly correlated. Now here the standard deviation of the portfolio is less than the weighted average standard deviation of the stock. Mathematically method portfolio standard deviation greater than the weighted average. Did you get the point? The confusion is normally this is okay, this is theoretically, they don't worry about this one, this is rule of thumb, but based on this correlation coefficient, this is 0.92, right? 0.92. So based on that, you can tell there is a small decrease of diversification effect. I will check it. But for the answer, you can tell since the correlation coefficient is less than 1, 0.92, so then you will get the diversification benefit. 8.4 average portfolio is hidden. Here, the very bottom is 6 point hidden. What hidden? 6 point? ඒක හරියට ඒක වඩා තියෙන ප්‍රශ්නේ මෙන්න මම බලන්නේ කොතනද මිස්ටේක් එක කියලා. ඒතකොට මේකේ ස්ක්වෙයාර් රූට් එකට අපි ගත්තේ. මේක හරි variance how much? 71ද? variance ගත්තානේ. බලන්න හදන්න අනිත් මේ එක මෙහෙම වෙන්න බෑ මට මේ ප්‍රශ්නේ මම මේ කන්ෆියුෂන් එකේ ඉන්නේ සාමාන්‍යයෙන් අපි කියන්නේ weighted average standard deviation එකට portfolio එකේ risk එක අඩු වෙන්න ඕන. දැන් මේක perfectly positive නෑ අපේ discussion එක මතකයිද? දැන් ඔයාලා උත්තරය ආව නම් හරි. මම හිතන්නේ මෙතන මගේ මාර්ක් එක මිස්ටේක් ඇති එක්සෙල් එකේ. Right, I will do it again. 0.6 into 0.6 into variance plus 0.4 variance plus twice. 6.84. Now it's working. What do you want to make this connectivity? You are good there. I'm very happy about it. So now you can see this is the weighted average standard deviation 6.97. So this is our portfolio risk. Portfolio standard deviation 6.84. So it is less than the weighted average standard deviation value. Since the correlation is 0.92. Less than 1. So therefore, very insignificant, that's not much. Very small decrease of diversification effect is possible. ඒක ඍණපත්‍රයට යන්න යන්න තමයි diversification advantage එක වැඩි. Okay. මේ උත්තර ආවේ නැද්ද ඔයාලට? Any confusion? But तुका खरे मागे सेल फॉर्मॅटिंग मध्ये इश्यू आहे का मी त्याला दिली सेल वेगवेगळे फॉर्मॅट करा तर इश्यू आहे का वाला काढले केलं ना वाला करेल ना so this is the correct this is the answer right so the exam you should be able to find a question like this and any queries any question last one but overall आणि ते खाताना ब्रेक काय करायला आणि ब्रेक करून ब्रेक काय करायला ते मिक्स करायला ते लगे हमारे लिए हमारे पर रिफ्रेशन है तब वाला जगह पर ये वाला ट्रांसलेशन और कैलकुलेशन इशू करते हैं वहां के इस तरह का समझ लो वाह तो ये तो किया कितने मम्मी बात तो नहीं करना कोई नहीं बड़ा लाभ होता है ये तो वाला नहीं है thank you yes it is and then if you don't need tricks, I can continue that two questions also. Allah is not bad. Yeah. Right. Right. Two more questions I promised to discuss with you. Let's look at this one, see whether you can manage it. So this is related to again that forecast return for the common shares PQR and the market portfolio. Right. So that is market portfolio are provided below. So you are given PQR stocks and the company and the market portfolio. So beta coefficient calculation is there. Let's do quickly, right? Expected return, variance, standard deviation for the PQR and the market portfolio, covariance, correlation for the PQR and the market portfolio. Then estimate the beta coefficient for the PQR company and say interpret the beta systematic risk of the PQR. Do it quickly also. We'll do quickly. Yeah? So you can do these things PQR, PQR and the stock market portfolio. So probabilities are given 0.3, 0.4, 0.3. 0.3, 0.4, 0.3. 32, 15, 30. 40, 20, 30. So here also you have to calculate expected return for the PQR market, variance, standard deviation for both. So like earlier for other stocks, individual stocks, you can calculate expected return, standard deviation, variance for market as well as this PQR stock. So let's calculate the expected return. PQR as well as the market. Then calculate the variance also, right? I hope you are not required this section. Now you have write down these numbers, so I'm going to Excel so you can check my answers also. It's taken 24 by 6, 29. So variance PQR as well as you have to calculate variance for the market. Then standard deviation for the market as well as the PQR stock. Standard deviation is correct. Then for variance and also correlation for the market and the two stocks. PQR. So correlation you can calculate covariance divided by standard deviation PQR and standard deviation R. Nine to correlation. You get it? Right. Yeah? Okay. Then question asks you to calculate beta coefficient. Now all others are done. So beta coefficient, calculate the beta coefficient. So you can remember the formula beta and the systematic risk measure is the beta. So beta coefficient for the PQR, you can calculate covariance PQR with the market portfolio divided by variance of the market. Covariance between the PQR stock and the market portfolio divided by variance of the market. So then beta is equal point 0.87 0.87. Got it? 0.87 covariance between the market and the PQR is 60.6 60.6 divided by variance of the market. Variance of the market is 69. 69. Covariance එක ගන්න හැටිද? අපි කලින් ගත්ත විදිහටම තමයි covariance. Covariance between PQR and the market equal. If you need, I will show the formula also. I believe you have noted it now. Covariance we can calculate using this formula. Using this formula. Forecasted return of the PQR, deviation from its expected return in the first probability, and the deviation of the forecasted return from the market into its probability. So likewise, we have three probabilities in our case, so we have to consider these three. So that total or the summation is the covariance. So let's go to the section. So here covariance is equal. Forecasted return stock PQR 32 in the first state of economy. Its deviation from its expected return 24.6 into in the same state of economy market forecasted 40% return, deviation from its expected 29. Probability of happening in this first state of economy is 0.3 plus next 15 forecasted in the second state of economy, its deviation from the expected. In the market it is 20 into probability of happening it 0.4 plus in the third state of economy PQR forecasted 30% deviation from the expected into market also 30% deviation from its expected probability 0.3. So get the total here. It is the covariance 60.6. Now here beta is 0.87. What you can say about the systematic risk of the PQR? What is the PQR company systematic risk because beta is 0.87. Beta coefficient is 0.87. So what you can say about the systematic risk? So what is the interpretation of the 0.87? How to interpret it? Yes. Now the relation is positive. The number when the market is increasing by 1%, this stock return is increasing 0.87. If market decrease or if market drop by 1%, this stock return is company is dropping by 0.87. So what you can say about the systematic risk? Is it high or low? With the market portfolio, with the market portfolio is the economy. That is the making systematic risk value. This is the measurements of the systematic risk. Beta coefficient is the measurements of the systematic risk according to the cafe. Now the beta coefficient is 0.87. So the exam you will ask a question. What you can say about the systematic risk of this PQR company? Is it high or low? What is the benchmark? 1. Always in the market portfolio, beta coefficient is 1. Compared to the 1, now it is less than 1. So it is low, not the high. If it is say 1.87, under systematic risk value. And market they are 1.87 1 lakh. So that is high systematic risk. Higher the risk, higher the expected return. Market if increase by 1%, the stock is increasing by 1.87. Higher the risk, higher the return. But the systematic, that the other part is downside is if market is dropped by 1%, this company is dropped by more than the market. So then here systematic risk is low because it is 0.86. If it is less than 1, then systematic risk is high. If it is greater than 1, systematic risk is high. Right. I think This other one, I think that's not much difficult. Now look at this one. Beta value of the Oxford PLC common stock 1.5. Now, how about the systematic risk Oxford PLC? High, greater than 1. Higher the systematic risk, higher the return, required rate of return, but the downside of that, if the market is dropped by 1%, discounted return is decreasing by 1.5. That is the mean. Expected market return 15% and the risk-free rate of return is 8%. So determine the expected return of the Oxford PLC. Determine the expected return for the Oxford PLC. Now, no any other ways. You have to apply capping. Because market informations are given, so you can apply capping, capital asset pricing model. So expect a return based on this systematic phase, or the required rate of return, or expect a return, both we are using. Difference is there, but anyway, I am not going to tell you that difference now. Is equal, according to the capping, risk-free rate of return plus beta coefficient into market return minus risk-free rate. So beta here, risk-free rate is 8% plus beta is 1.5. Market return is 15%. So 15 minus 8. So how much the expected return? Is it? Eight, 18.5. Now here also you can observe for this Oxford PLC, investors' required rate of return is greater than the market return because of the high systematic risk. Because it is systematic risk is 1.5. How much the market risk premium here? Market risk premium is how much? Market risk premium is the difference between market return and risk-free rate. So market risk premium is equal in the market the premium given for systematic risk. That is the market risk premium. So that is equal to market return minus risk-free rate. Make market risk premium. This is the market risk premium. So how much the market risk premium? 7%. In your question, if the market risk premium is given, so quickly you have to substitute that market risk premium. Finish. This one, last one, right? Following information relates to two common stock, gamma and delta. So beta value is given 1.3.6 like, expected return 16.5, 13%. Assume these common stocks are correctly priced, right? Correctly priced, so that means that these stocks are on the SMA. On the SMA, secondary market line, correctly priced. According to the capital asset pricing model, how much is the risk-free rate and expected return of the market? How much the risk-free rate of return and the market return. So these two stocks are correctly priced. So according to the capital, they are on the ascending market line. So according to the capital, you know that required rate of return is equal risk-free rate of return plus beta coefficient into market return minus risk-free rate. So here this is given expected return based on the future. This is expected return is given. Beta is given for these two stocks. Beta also there. So you have to estimate risk-free rate and market return. Risk-free and the market. Yes. So if you apply the capital model for the gamma, so 16.5 is equal. After risk-free rate of return plus beta is 1.3 into this difference we defined here as the market risk premium. Right? Market risk premium. Difference between the market return and risk premium is the market risk premium. If you write the delta, 13% is equal. Risk-free rate is not known. Beta is 0.6 into market risk premium. This is mathematical issue from the finance. So now you have to solve these two formulas for the risk-free and the market risk premium. If you know the market risk premium or the risk-free rate, you can estimate how. So if from this, say this is 1, this is 2. From 1, you can write the formula like this. No, if you solve this for the risk-free rate, 16.5 minus 1.3 market risk premium equal to risk-free rate. So now we substitute this to the second formula for the risk-free rate. So then in the second formula, 13% is equal, instead of the risk-free, now we are writing this 16.5 minus 1.3 into market risk premium plus 0.6 into market risk premium. Now you can solve. Make good one in the reason that they can think that method minus positive. Yeah, make a minus, 1.3 only 0.6. Now simple mathematics. 1.3 only 0.6 is what we did. This is minus 1.3 into 1.3 minus 0.66.7 minus 0.7 බලන්න හරියට කියලා. මේක අපි අරන් එනවා මේ පැත්තට. මෙයා පොසිටිව් කරගෙන. ඉතින් 0.7 market risk premium is equal 16.5 minus 30. 16.5 minus 13. 3.5 divided by 0.7. Market risk premium is equal. Market risk premium is 5. එහෙනම් අපි මේකට මේක ආදේශ කරන risk free හොයාගන්න. මෙතන මෙතන 5යි නම් එහෙනම් 5 වෙනි කිරීම 1.3 6.5 या මේ පැත්තට ගෙවුවොත් අඩු වෙනවනේ 10 6.5 ගෙවුවම risk free rate is 10 risk free rate is 10%. Market return එක කීයද? මෙතන අතර වෙනස 5ක් වෙන්න නම් market return එක 15ක් වෙන්න. Market risk premium is equal 5. The market risk premium is equal 5 කියන කියන්නේ market return minus risk free rate. The risk free rate එක 10යි නම් එහෙනම් මෙයා 15යි නේද? Market return is 50. Mathematics, not the finance. හරි නේද? එහෙනම් 15යි. That's all. This can return is over. Now we are going to cost of capital. Any questions, any clarifications, anything if you need? Let's send out the risk capital. Any question? Right. So we are going to our next lesson, that is cost of capital. Not difficult like risk and return. It's very easy. So cost of capital. So you know that companies or the business organizations, they are raising their funds using different sources. Because the company can issue shares, debentures, preference shares, that also likewise. So many sources are there to finance. So these financing sources are with their cost. Right? So as a finance manager, you should know what is your cost of capital. Right? So you are financing funds, suppose you are taking bank loan. So the cost of that is the interest. You have to pay interest to the bank. Say it is 15%. So using this bank loan, suppose you are investing in a certain project, right? So then from this project you have to generate at least 15% to to survive it. Not sufficient earning 15%, you have to earn more than 15% in order to create value. But anyway, at least you have to have 15%. So likewise, as a finance manager, you should know what is your cost of capital. So that is a very, very important variable. Without knowing this number, you cannot take the investment decision. You cannot evaluate investment. And also, every other decision also affected with the cost of capital. So conceptually, this is very strong one. This is without knowing that investment is dividend related, working capital related. Every decisions are affected with this one. Right. So therefore, we are going to calculate this one. Now, if you look at this, now here. This is a PLC company. Their capital structure, how they have financed their capital requirement. Say, debt capital is there, preference shares are there, equity capital is there, 1 million. So you are given cost. So 19%, 15%, 28%. So this is we are going to calculate now. How this 19% calculate? This 25%, how you identify? And overall, we are paying tax also. So then, if it is the capital structure, so what is your overall cost of capital? These are the sources of capital. Or cost of capital, you have other sources also. So you have to consider all. You have debt, equity, preference shares. So then considering all, what is your cost of capital? Overall, weighted average cost of capital. So that is what we are going to do. So at the end, when you are reaching the end of this one, so you will be able to do this calculation. You will be able to determine the cost of capital for this company with this given information. Right, learning objectives. So you will learn, you will identify different sources of financing for different types of organization, and also you should be able to calculate cost for each component, cost of debt, cost of equity, and the cost of preference shares. Then you have to, using this component cost of capital, so you have to calculate overall cost of capital, or we call weighted average cost of capital. This marginal cost of capital is also very important, especially in the investment. Now, suppose our total capital is 100,000. Our total capital investment is 100,000. For this 100,000, our cost of capital is 12%. Now we are going to invest in the new project. So we need some more money for that. So this 100,000 is not sufficient. So company might have to issue new shares or have to take bank loan. So when they are taking these things, company risk factors are changing. Their business risk, financial risks are changing. So what is this marginal cost of capital? If you are raising 1 rupee from here, if you are raising 100,000 and 1 rupee, if you are increasing this 100,000 by 1 rupee, what is the relevant cost? That is marginal cost of capital. This is our existing total capital, but this is not sufficient. When the investments are coming, you have to increase this. You have to raise additional capital. So that marginal cost of capital is cost of raising additional rupee. So that is marginal cost of capital. So finally you will learn it, how to estimate the marginal cost of capital, because it is very important in the capital budgeting, in the investment evaluation. Our next lecture. So these are the learning objectives you will learn at the the end when you are reaching. Right. So let's see what are the sources of capital. I told you this is very not much difficult. Sources of capital. So these are the type of business organization. It can be a public company, private, partnership, sole proprietor, charity, club, different types of business organization. Maybe for profit or not for profit. Now, if it is a public company, what are the sources of finance? You know, can issue shares, debentures, and also bank loans. And the other thing I want to mention, here we discuss long-term financing, right? Not the short-term. Now, you know that company can take a short-term financing using a bank overdraft. Right? It's not affecting to the capital structure. It's a temporary arrangement for the certain period, maybe less than 1 year. So therefore, our focus here, total capital structure, that is long-term finance, like issuing debentures, issuing ordinary shares, preference shares, long-term bank loans. These are the sources. If it is a private company, what are the sources? They also can issue shares. But what is the problem? What is the public company and private company limits? Private company also can issue shares. Even debentures can issue. But what is the limit? I think you know that. Huh? Huh? Oh, that is okay. Private company are listed under that. It should be a public company. In addition to that, sir, one difference, that's okay. Public company, PLC company can issue share to the general public. They can invite all the people in the country to invest. But for the private company, they can issue shares among only their shareholders. What is the number? According to the Act? Huh? 50. Between these 50 shareholders, they can issue shares, debentures, everything they can do, but between that shareholders. That is the difference. If they want to raise more capital, they have to be a public company. They have to list it. Then partnership, you know, basically coming with the partner's capital, bank loan, they cannot issue shares. Basically funds are coming from the partner's capital and the loans. Sole proprietorship, own money from the friends, family, so likewise some other pools. So these are the sources of capital. If it is a charity, it's not a corporate organization, but they need some capital to do their activities. So capital is coming from charity, donation. Basically, they are coming funds from the donation. Then club societies, membership fee. So likewise, these are different types of organizations. So there are different sources of capital for them. Our focus on the public company. So we are going to estimate this cost of capital relating to the public companies. Assuming that they are issuing shares, debentures. So likewise, because public company only can issue shares and debentures to the general public, even private company can within 50. So that theory, the things you are learning, you can apply to the private company also. But anyway, when we apply CAPM like things to the private company, we cannot apply capital because we cannot estimate beta. Then beta done beta private companies, for the private company, beta you cannot estimate because beta we are estimating related to the market portfolio. But this private company is not listed, no? So then we cannot estimate beta like this. This is unlisted company. So therefore some models we cannot apply to the private company to estimate the cost of equity. That limitations are there. I will remind it when we discuss the methods also. Our focus on the companies, mainly the public companies. Right. So this is the capital structure. So basically you can divide capital structure as debt capital and the equity capital. It can be debt and the equity. When it's come to the debt and equity capital, what is the difference? Huh? Under the equity capital, I have mentioned common stock and the preferred stock, and the debt capital, corporate bonds, and the other type of borrowings. This preference shares actually we consider as a hybrid security because some scholars, some textbooks categorize it under the debt capital, and also some says it under the equity capital. So there is some dilemma for the preference shares, so the preferred stock. But anyway, this won't be a problem for you. But my question is, what is the difference between equity capital and the debt capital? Ownership, okay. Equity capital represents the ownership, debt capital, and no representation of the ownership. That is correct. Any other? My expected answer is not that. Yes. That is okay. Our feedback is other equity shareholders are getting regular dividends. Yes, but debt capital, bank loans, corporate debentures, are they getting the fixed coupon? What is the main difference? Main difference is debt capital is from the company point. It is fixed cost source of financing. Equity capital is a variable cost source of finance. From investor perspective, it is a fixed income security. Debt instruments are the fixed income security because you are getting fixed income. Interest, coupons, they are fixed. Irrespective of the profit, irrespective of the performance of the company, you are getting interest. But equity, not like that. Dividends depends on the profit and the availability of the investment, the board decision, lot of factors are there. It is affecting with the things, so that is variable source of capital. Right. So basically, we can divide under the debt and equity. I think no need to explain this thing because in the A-levels also you have identified this thing. I am going to the right. When it's come to the cost of capital, this cost of capital determined by the market, capital market. It depends on the demand and supply condition. Now suppose I am a company. I have an investor. I need some money. So I am issuing debentures. So I declare my coupon rate. So you are the investors. If you satisfied with my coupon rate with the prevailing interest rate, you may invest. Otherwise, you may go to the other alternatives. Right? So likewise, this cost of capital determined by the capital market in the broad sense. That is affecting with the demand and supply condition. So therefore, this cost of capital is the current market investors required rate of return. It shows the current situation. It's not the historical thing. It depends on the current expectation, current required rate of return. Depends on the market requirement. And it depends on the risk associated and the term to maturity. I think that point now you can understand. Risk associated and the term to maturity. Now, if you are invested in the equity by company, and also you have opportunity to invest in the debentures of my company, your required rate of returns are same. Huh? No, you know the reason. What is the reason? Your required rate of return for the equity investment definitely should be greater than the required rate of return of the bonds or the debentures investment. Because of what? This. Because of this. Because you know that in case my company bankrupt, if you are invested in the equity shares, you will be owner. You are a residual owner. So what is the meaning of the residual owner? In case of the bankruptcy, you have to wait until I have settled down all other obligations. First, bank loans, corporate debentures, bonds, preference shareholders requirements, and then finally something remains. You can. So that is we call residual ownership. So therefore, you are taking risk in that aspect. And also, suppose my company is running with a prosperity. I have the investment, I am creating value, I am giving high dividends for you. So that is my a good scenario, a good position. So then your return is high. So you are getting high return. Higher the risk, higher the return. Downside if it gets worse, you have to face high risk. So therefore, it depends on the risk associated and the term to maturity. In the time value of money, you learn it. If you have to wait long time to get some return, what happens to the value of that? Value is increasing. Time value of money receiving today more valuable than money receiving tomorrow. Right? So therefore, if you invested in the ordinary shares, you have to wait 5-10 years until these investment projects are success to get the value. Value created impact. So you have to wait long time. So then your risk is high. Again, your required rate of return is high. So that depends on the risk associated and the term to maturity. So this is equal to the equilibrium rate of return demanded by investors in the capital market for securities of the that decrease of risk. Suppose I am issuing corporate debentures. So if my coupon rate is not correctly priced the existing risk, so then you may not invest. You may go to the other suitable investor. Right? Can be broad talk areas, but I have to be in the bullet form. So that depends on the equilibrium. You know what is the equilibrium point, where the demand and supply may intersect. So that is the equilibrium. So it is the equilibrium, where rate of return demanded by investors in the capital market for securities of that decrease of risk. Intersect with. So that depends, that decides the capital cost of capital. So that is in the conclusion what I want to say, cost of capital determined by the market forces, demand and supply. Even though I offer lower coupon rate, so you may not invest. You may go to the other fixed deposit. You may invest in the other companies. So likewise, demand and supply conditions should be matched. Right. So then, if you look at this diagram, you can see risk return trade-off. Before that, this cost of capital, when you are doing the time value of money, in the time value of money, what we done? Cash flows receiving in the different time periods, you calculate present value, compounded value, so likewise with the different time periods. At that time, you define it as the discount factor. When you are calculating the present value, you call it as a discount factor. So discount factor is same as the cost of capital. अब ये दा discount factor के लिए दा वाला cost of capital को ना तेरे में इधर आप में cash flow time register को बटा आप पाविची कराने company cost. So this company cost of capital is the appropriate discount rate. In the time value of money, we define it as the discount rate. And also, this cost of capital is the minimum required rate of return required by our company investors. Now look at this capital structure. We have issued some debentures. We have some bank loans. We have issued some ordinary shares. So considering all these things, we are calculating company cost of capital. Right? This is the cost of capital. So this cost of capital is the minimum required rate of return of the investors of this company. Minimum. Apabila minimum making, අපි value එකක් create කරන්නේ අපි secure කරගන්න minimum එක නම් in the long run we may face to the trouble. Because this is minimum, so you have to, from your investment, you have to earn more than 12% in order to create value. So this is the minimum required rate of return. So roughly capital cost of capital කියලා කියන්නේ this is minimum required rate of return that we should secure from our investment. So අපේ investment එකක් අපි evaluate කරනවා නම් අපි හිතමු we have that IRR, internal rate of return. Suppose here cost of capital is 12% for this company. You have a project, your IRR is 9%. Can you accept that project? No. Because this project internally generated rate of return 9% less than the cost of capital level. In order to create value, our objective of financial management, what is the objective? Maximizing shareholders' value, creating value, maximizing value of the company, market price of the share. In order to create value, you should earn more than 12%. 12% is minimum. Minimum වලින් value එකක් create වෙන්න minimum එකේ cost එක cover කරගෙන survive. But to create the value, you have to earn more than 12% from your investment. So that is why I mentioned without knowing the cost of capital, you can't do the investment. You cannot calculate NPV, what we call that profitability index and the things. So you should know what is the cost of capital in order to do these things. So this is very important number as a finance manager. In your hand, you should know what is your cost of capital. For every decision, every discussion, you should know your cost of capital. So that is cost of capital or cost of money. So likewise, same meaning. And also I forget that thing. In the security valuation, we have bond valuation, ordinary share valuation, preferred share valuation. In the security valuation, intrinsic value we calculate by discounting expected cash flows from investors required rate of return. Investors require rate of return. So this is the company, right? This is the company. These are the investors. The company can issue the bonds. The issue කරපුවම මෙයා coupon එකක් දෙනවා, මේ පැත්තට dividends එනවා. So these are the returns. So then here this is investors require rate of return. When you are investing in the ordinary shares, you have your required rate of return. So this required rate of return from the company perspective, it is cost to the company. In order to hold this investor with the company, so you have to satisfy this required rate of return. So this investors required rate of return from the company perspective, our cost of capital. It is our cost of capital. Then we estimate the company cost of capital. What is our cost of capital? Right. Now, once you look at this one, what you can see here in the y-axis required rate of return. This is risk. So you can see some sources of investments are there. They have ranked based on the risk. Now, if you look at here, this is common stock. It is the security with the highest risk. So therefore, you can see its risk is high. So the required rate of return also high. And also in between this common stock and the corporate debentures, you can see preferred stock. This order is coming from the theory we call pecking order theory. Pecking-order theory. According to this pecking-order theory, it says that if a company went bankrupt, first we have to settle the debt, bank loans, debentures, kind of debt. Then preference shares. After finally ordinary share. So therefore, compared to the debenture holders, preference share holders risk is high or low. Compared to the debenture holders or the bond holders, the risk of preferred stock holders, preference share holders, is it high or low? High. It is high because you can see, so therefore its risk is high and also the required rate of return is high. So then corporate debentures, bonds, bank loans. So likewise, these are government securities. Now in the government securities also you can see, even though we say the government securities as the risk-free investment, some sort of risk is there. Only the default risk is free. Only the default risk or credit risk. Default or the credit risk. Only default risk is free, but investment risk, market risk, foreign exchange rate risk, country risk, everything are affected with the treasury bill and the treasury bond investments also. So therefore, it is not going to zero here. So you can see it is somewhere here. Some sort of risk is there, like other market risk factors. Only the default risk is free because it is issued by the government. Theoretically, we believe government never be a defaulter. So therefore, we assume that no any credit risk. Right. So this is the risk return trade-off for the different or the various sources of funds. Right. So therefore, you can see higher the risk, higher the required rate of return. Lower the risk, lower the required rate of return. Right. So now we are going to estimate. In order to estimate the cost of capital, we have to first identify cost for each component. Now, cost of debt, how to determine, cost of preferred stock, how to determine, and then cost of equity, then weighted average cost of capital. So, therefore, in the process, first we discuss cost of debt. Right? Cost of debt. Right? Any questions? Am I fast? Are you tired? Right. Cost of debt. So what are the debt sources? It can be a bank loan or the corporate bonds or the debentures. What is the difference between the bonds and debentures? I think at that time I told you. Yes, what is the difference? Huh? Debentures? What is the difference between the bonds and debentures? Features are same, but some sort of difference is there. What is the difference? Anyone? Huh? Bonds debentures both are source of debt. Huh? Security the bonds of the debentures. Huh? Bonds. If the bonds is issued with some sort of collateral, keeping some security. So the collateral we call it as a bond. That is without any collateral. If that issued, that is given. Right. Okay. Now what you can see here. By the base of the against the Harrier, is that? अबे एग्रीमेंट के में से एक हाथ में वाले 20% 3 hours का था चेक कर